Welcome to the Lane Gorman Trubit Summer Survival Webinar Series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive the summer. Legislation, tax policy, and a business environment that is constantly in flux can make it difficult to keep your head above water. In this webinar, Lane Gorman Trubit, along with Pulsinelli, present Are the Finances for Your Company Secure? This insight will help you survive changes in the Secure Act and CARES Act and will guide you through what to do during your benefit plan audits. This presentation was recorded live as a Zoom webinar on July 29, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have questions, please feel free to email us at askus@lgt-cpa.com.
Okay, hi everyone. Hope you all can hear me fine. We are so happy to have you here with us for our summer survival series. Of course, we'd love to be doing this with you in person, but I'm so excited we have this platform so we can still share this information with you during these unprecedented times. We have several great presenters lined up for you today. My name's Callie Nixon. I am a CPA with LGT. I'm a senior manager in the Assurance Services Department, coming up on my 6-year anniversary with the firm. So today I'm going to be talking to you about some recently enacted legislation affecting your company's retirement plans. I normally focus on the manufacturing and distribution clients during busy season, but during the summer, I'm all about the 401k plans and love staying up to date on that new legislation. So I'm here to bring that information to you. So we will be touching on 3 newly enacted legislation. We'll briefly touch on the Bipartisan Budget Act, which is already effective. It was released in 2018. We're mainly going to focus on the Secure Act of 2019. And then at the end, if we have time, we're going to briefly touch on the CARES Act from 2020. So the Bipartisan Budget Act, this was signed into law in February 2018, and it is all about hardship withdrawals from your 401k and 403b plans. So normally there are several provisions and restrictions on hardship withdrawals and some hoops that the participants have to jump through to be able to get one of those. So this act, it has some provisions that are mandatory, some are optional. The mandatory effective date applies to all distributions made after January 1, 2020. So these mandatory provisions are already effective. If you are unsure if your retirement plan for your company has implemented these, I would suggest you talk with your third-party administrator or TPA for the plan to make sure those are taken care of. So the optional changes from the Bipartisan Budget Act is it eliminates the requirement that a participant has to take a plan loan before they take a hardship withdrawal. It expands the amounts eligible for hardship withdrawal. So typically a hardship withdrawal can be distributed from a participant's vested employer and employee contributions. It normally couldn't be made from earnings or other kind of non-traditional contributions like qualified non-elective contributions, QMAC, QACA safe harbor contributions. So this allows an employer to expand those contribution sources that the hardship can be withdrawn from. And it also adds a hardship withdrawal reason for disaster events. Again, all 3 of those are optional. It is up to the plan sponsor whether they want to add these items or not to their hardship withdrawal provisions of their plan. The 3 mandatory items that were mandatory January 1, 2020 is eliminating the 6-month suspension of deferrals after a participant takes a hardship withdrawal. Under normal safe harbor rules for hardship withdrawals, if a participant takes that hardship withdrawal, they were not allowed to make any elective deferrals to the plan over the next 6-month period. Essentially, that was due to because the employee was in such hardship that they shouldn't have the means to be making those deferrals after taking that hardship. So this is mandatory that those deferrals are not suspended after hardship withdrawal, and any employee who currently had suspended deferrals from a hardship withdrawal must be unsuspended at that time. The Bipartisan Budget Act, it also eliminates the catch-all relevant facts and circumstances test when evaluating whether a financial need is heavy and immediate for the hardship withdrawal. Instead, it replaces that with a representation that the employee must make that their financial need is heavy and immediate. The Act also clarifies that hardship distributions for a casualty loss do not have to be tied to a federally declared disaster. So when should your plan make amendments? Individually designed plans, those amendments would be due by December 31, 2021 in accordance with the 2019 required amendments list from the IRS. For pre-approved plans, those would be more of your check the box adoption agreement type plans. Those amendments are normally due by the later of the plan sponsor's tax filing deadline or the last day of the plan year in which the amendment is effective. So if it was January 1, 2020, most likely those amendments would be due by the end of this year. If your plan is a safe harbor plan, make sure any participant notices have been given to your participants. And you should also consider any time an amendment is made to the plan or additional provisions are added or taken away, always consider whether a summary of material modifications should be distributed to your plan participants. In lieu of one of those, an updated summary plan description can be distributed instead. So again, if you're unsure from the Bipartisan Budget Act if those amendments have been made and if you are up to date on that legislation, which is already effective, please talk with your third-party plan administrator to make sure you're in compliance. Okay, so our next legislation is the Secure Act of 2019, and that is setting every community up for retirement enhancement. That was signed into law on December 20th, 2019. So this is also around the time when our first case of the coronavirus or COVID-19 surfaced. So about 3 months later, COVID-19 was declared a pandemic. About 2 weeks after that, the CARES Act came out. And the CARES Act has gotten a lot of attention, much deserved attention during this time. But because of that, the Secure Act kind of fell by the wayside. And the Secure Act is the first major retirement-related legislation since the Pension Protection Act of 2006. And that's the act that gave you those automatic enrollment features, the safe harbor investments that went with our recent restatement of plan documents. So because this has kind of fallen by the wayside and hasn't really gotten the focus that it needs, most of my presentation will be focused on the Secure Act. We're going to discuss 9 of the main provisions that the Secure Act did, their impact to you, their impact to you as a plan sponsor and you as a participant in a 401k plan, and actions that your company should be taking now. So the 9 items that we will discuss, they are not all inclusive. The Secure Act actually does a lot more than that. At the end of this section of slides, I do have a link to the full text of the Secure Act in case you want to look at the additional provisions. But the one I want to talk about first is the penalties from the IRS for failure to file those retirement plan returns or your Form 5500. So the Secure Act actually increases those penalties by 10-fold. So failure to timely file your Form 5500, which is your annual tax return for your 401k plan or retirement plan, that used to be $25 per day and it was capped at $15,000. That is now increased 10 times to $250 per day or $150,000 per year. Also the Form 8955 SSA, which is your form for any separated participants that still have deferred vested benefits under the plan, used to be $1 per day. That's now $10 per day with a max of $50,000. And a failure to file notification of change in status of the plan. So that would be if you changed your plan name, if the plan administrator changed their name or address, if there was a termination of the plan. Normally those notifications are made to the IRS through the filing of the Form 5500. So in addition to your $250 a day penalty for failure to timely file the 5500, you're also going to be hit with $10 per day for this failure to file notification if you did have a change such as this during the year. So these increased penalties are effective this year for calendar year plans. So any tax filing that needed to be made after December 31, 2019. So if you have a calendar year retirement plan, your Form 5500 is originally due July 31st, which is this Friday. unless you have made a valid extension for your plan and filed that to extend that due date to October 15th. So in this case, these penalties are effective this year. So if you're questioning whether you've gotten that Form 5500 extension done, you've got about 2 more days to do it before you incur these penalties. So make sure to get those 5500s and the extensions filed timely this year to avoid these increased penalties. Now, the penalties from the Secure Act, it doesn't change the penalties imposed by the Department of Labor. The Department of Labor penalties for failure to file the Form 5500, those are still increased annually based on inflation. So currently those are about $2,200 per day, which would be in addition to any IRS penalties you may incur for late filings. One of the big things from the Secure Act is it requires the 401k plans to offer participation to long-term part-time employees. So right now, most 401k plans say that if a part-time employee works more than 1,000 hours in a year, that they can make elective deferrals to the plan. Of course, that can change from plan to plan, depending on your specific plan provisions, but that's a general one I see in the 401k plans that LGT audits each summer. So the Secure Act, beginning with 2021, if you have any employees that work more than 500 hours in a year for a period of 3 consecutive years, those employees have to be allowed to make deferrals to the plan. So it would begin tracking with 2021, whereas on January 1, 2024, those long-term part-time employees meeting those requirements would have to be allowed to participate in the plan if they so choose. So you do not have to provide an employer match on these contributions unless the plan sponsor chooses to. And the plan sponsor can still impose the same age restrictions on any other participant that they would normally do. So if you have to be 18 or 21 to participate in the plan, that would also apply to these long-term part-timers. So what employers need to do now is make sure they have a mechanism for tracking those hours, because starting in 2021, you're going to need to track your part-time employees' hours for 2021, 22, and 23 to determine who can participate beginning in 2024. So what implications could this cause? I've foreseen several issues that it may cause that plan sponsors and employers need to consider with this. So if you have those long-term part-timers come 2024 that need to be able to participate, those number of employees, that count of additional participants, may put that plan over the 120 eligible employee limit at January 1, 2024, which may trigger a plan audit. So if you've been following what's called the AB 120 participation rule, where you've been filing as a small plan due to the number of participants you have, once you reach 120 at the beginning of a plan year, you're going to have to file as a large plan, which requires an annual plan audit to be done. So because these employees, these long-term part-timers, are going to count towards that overall eligible participants, that may start triggering plan audits for those who used to not need one. And although they do count, the long-term part-timers do count for these eligible participants, they don't need to be included in the non-discrimination testing or the safe harbor requirements. So plan sponsors and TPAs, those third-party administrators for the plan, are really going to have to monitor those to make sure that they're giving the right information for the right things. With this new provision, you may also have a dual eligibility requirement for your part-time employees. So you may have part-time employees that meet 1,000 hours during the year, and you have to offer participation to them, or you may have these long-term part-time employees that have worked over 500 hours for the past 3 years that also need to be offered participation. So you kind of have these two different things that you need to be tracking for the part-timers. Additionally, because you don't have to match those long-term part-timers that are making deferrals, is your payroll system able to distinguish between who needs a match calculated and who does not? Additionally, if you're changing payroll providers during this period leading up to 2024, you need to be making sure that you have the data from that old payroll system to be able to track these hours for your part-timers. to make sure you have that information come 2024 before you get locked out of that old payroll system. So a lot of things to consider with this, a lot of implications that it may cause that employers are going to want to start preparing for now and talking to their payroll providers and their plan document providers and make sure they're excuse me, ready for that come 2024. Okay, the third thing we're going to talk about is required minimum distributions. So since feels like forever, this has always been the age 70 and a half rule. Whenever a participant turns age 70 and a half, by April 1 of the next year, they will start taking required minimum distributions from their 401k account. So that age has now been increased to age 72. This was essentially to allow people to contribute longer as people are currently working longer past that retirement age so that they can earn investment income longer and to adjust for current mortality rates. So for any employee who had not turned age 70 and a half by the end of 2019, their first RMD will now occur once they turn age 72. Something to remember would be the June 30th, 1949 date. So if your employee was born on or before that date, they will follow the old 70 and a half rule. If they were born after that date, they're going to follow the new age 72 rule. So another nice thing that the Secure Act does, it provides for an in-service withdrawal option for birth and adoption expenses. So previously there was no special relief for participants for their birth or adoption expenses, but now if the employer chooses to elect this option and add it to their plan, withdrawals up to $5,000 are permissible within 1 year following the birth or legal adoption of a child. They are not subject to an early withdrawal tax, and they have to be allowed to be recontributed back to the plan. While the participant doesn't have to recontribute them, they have to have that option if they can. It would be similar to a hardship withdrawal. It would have a 10% withholding rate for federal taxes, but the participant may elect out of that. And this would be effective for distributions after December 31, 2019. So if you want to add this provision to your plan document, it's something you can talk to your TPA about. For safe harbor plans, it provides an option to increase the automatic contribution cap for employees. So with the Pension Protection Act back in 2006, this allowed for the automatic enrollment provisions of the plan, where if an employee hasn't enrolled in the plan, normally by a year of service, they will be automatically enrolled. There's also something called an automatic escalation feature, where as long as the employee doesn't opt out of this auto escalation, normally each year, their deferral will increase by 1% each year until it reaches a maximum of 10%. The Secure Act allows that maximum percentage to be increased to 15%. So again, this is an option for the plan sponsor, but if they do wish to add that option, they can start talking to their plan document provider about that so they can get those amendments made to the plan. Changes to non-elective safe harbor plans. So the non-elective safe harbor plans, these are the ones that provide a fully vested employer contribution of at least 3% of each participant's salary, regardless of whether that participant makes elective deferrals into the plan. So the Secure Act does several things related to these non-elective safe harbor plans. It eliminates the annual safe harbor notice requirement. It permits a 401k plan to be retroactively amended so that it becomes a non-elective safe harbor plan, as long as that amendment is within 30 days before the plan year ends and that 3% contribution is made. It also permits a 401k plan to be amended retroactively so that it becomes a non-elective safe harbor plan, even if the amendment is not within 30 days, so long as the employer makes a 4% contribution and that retroactive amendment occurs within 12 months after the plan year ends. And one thing to consider with this is to ensure the elimination of the notice requirement for participants is not confused with safe harbor plans that meet those requirements through matching contributions. If your plan is a matching safe harbor plan, that annual notice is still required. It also allows employers to establish a new 401k plan after the end of the tax year. So normally or previously, employers had to adopt a new 401k plan by the last day of the taxable year for the plan to be treated as in effect that year. Now, the Act is trying to encourage more employers to establish 401k plans and is allowing them to establish those 401k plans even after the taxable year. So as late as the due date for filing the employer's tax return, including extensions. So while you can't retroactively establish a 401k plan in 2020 for 2019, in 2021, you can retroactively establish a 401k plan for year 2020, as long as you get that established before the employer's tax return. So if it's due by September 15th, it would have to be before that date. The really fun one is the pooled employer plans, or the PEPs. So it's allowing unrelated small employers to form a pooled employer plan. Previously, there were multiple employer plans, or MEPs. The participating employers in the MEP had to share common organizational relationships, such as being in the same industry, members of the same trade association, think several doctor's offices that pulled together to make a multiple employer plan. So the Secure Act goes a little further and allows pooled employer plans where the participating employers do not have to be related or have any sort of commonality. The legislation says 2 or more employers can form a PEP. It currently has no cap on this, or a maximum number of employers. So the Secure Act, it requires a pooled plan provider. So basically you would have one third-party administrator for the PEP, which could have currently endless amounts of participating employers in it. So continuing with the PEPs, normally the multiple employer plans, they previously had a bad rep. They weren't very popular because it had this one bad apple, where if you have one participating employer that's not doing what they should and is not following the rules, the entire plan could be disqualified. So the Secure Act actually insulates companies in the pooled employer plans from that risk, where if you do have that one bad apple participating employer, the other employers can basically force that bad apple out of the plan through a series of notices and protect those that are left behind. So the PEP, it would have a single pooled plan provider, it will have a single plan document, it will have a single Form 5500 filing, and a single plan audit. And those PEPs will apply to plan years beginning after December 31, 2020. The last item from the Secure Act that we're going to discuss is increased tax credits for small employers. So a small employer, those are considered the employers with 100 or fewer employees. So the tax credit for the first 3 years after adopting a new qualified retirement plan can equal 50% of the plan's startup cost, up to a maximum of $5,000, which that maximum was previously capped at $500. It also creates a new tax credit of $500 for small employers who implement auto enrollment in their plans. These changes are effective for taxable years beginning after December 31, 2019, so 2020 for the calendar year in plans. As I mentioned previously, the preceding items, they are not all inclusive. The Secure Act actually does many more things than those 9 that we discussed. So I do have the link here for the full text, and I'm happy to answer any questions that you may have regarding the Secure Act or research something further for you. Some things to be careful of with the Secure Act is it has a very broad range, and the effective dates of the Secure Act, they vary from provision to provision and should be paid close attention when determining what to implement and when. Certain provisions are optional, some are mandatory. Some require a plan amendment, some do not. So it's very important to work with your third-party plan administrator to know what to implement and when, and make sure that those changes are getting done timely. Although you can change the plan operation, some of those plan operation changes are necessary now. The formal plan amendments don't have to be made until the end of 2022 for a calendar year-end plan, and they can be made retroactively. So I would start talking with your third-party plan administrator today to make sure that you've got yourself covered on this. Okay, so the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. We are going to briefly touch on this. So the CARES Act, as I'm sure you all know, was the $2 trillion relief package that was signed into law in March 2020, just over 2 weeks after the World Health Organization declared COVID-19 a pandemic. So as the name suggests, the act is to provide aid, relief, and economic security for those affected by COVID-19. So the CARES Act, it's received much deserved attention for its stimulus payments and its PPP loans, which I'm sure you're all probably still dealing with. But the CARES Act, it also provided several relief provisions for employee benefit plans and retirement savings. So all of the employee benefit plan related provisions of the CARES Act are optional for plan sponsors, and they were all effective upon enactment of the CARES Act. So the first was the coronavirus related 401k distribution, or the CRD. So it allowed up to a $100,000 distribution for qualifying individuals. There's no early withdrawal penalty. It can be repaid or recontributed to the plan over 3 years, and the income tax owed on the CRD could also be paid over a period of 3 years. It also increased the loan limits for qualifying individuals. So normally a loan would be equal to the lesser of $50,000 or 50% of the participant's vested account balance. For the CARES Act, for qualifying individuals, this allows them to take a plan loan up to $100,000 or 100% of their vested account balance in the plan. And they could defer their loan repayments for a period of 1 year, though interest would be accruing during the deferral period. The loans were only available for a 180-day period from the time the CARES Act was enacted. So that ends September 22nd, 2020. So a little over 2 more months for those loans. One thing to consider if an employer is still trying to decide if they want to add these provisions to their 401k plan, allow their participants to take these CRDs or the loans, is to consider that in this time of need, when a participant, maybe they have been diagnosed with COVID-19 or a spouse or a family member, and they're taking these plan loans that could be 100% of what they have in their 401k plan. With terminations, with layoffs, individuals really need to consider whether this is going to help them or hinder them in the long run. Because even with the loan repayments, those will accrue interest over the year if the employee decides to defer those. So it would result in a larger payment once payments have to start being made. And if the loan is ever deemed, if there's a termination or a layoff, if they took 100% of their 401k account, they have nothing as collateral for the loan. So one thing that plan sponsors should consider when they're trying to decide if they want to add the CRD or the loan or both is to really think what's going to benefit their employees the most. Additionally, one thing to note for the CRD is you do not have to turn it on for the full 100,000. If you want to allow CRDs for 50,000 or 25,000, that's also up to the plan sponsor to decide. Both the CRD and the increased loan limits require the participant to be a qualifying individual. So that would mean that the individual has been diagnosed with COVID-19, that the spouse or a dependent of the individual has received a diagnosis of COVID-19, or the individual spouse or a member of their household, which is someone living in their principal residence, has experienced adverse financial consequences, such as being quarantined, furloughed or laid off, unable to work due to lack of child care, having a job offer rescinded, as well as the additional items listed here or other factors as determined by the Secretary of the Treasury. So originally, the adverse financial consequences, that only qualified for the individual. It was back in June that was actually expanded to also include the individual spouse or a member of their household. The last 2 items that the CARES Act did with employee benefit plans, it suspended required minimum distributions. It would apply to any RMD that would have otherwise been taken in year 2020. This is not limited to qualifying individuals like the CRD or the increased loan limits. It does only apply to defined contribution plans, so your 401ks, your 403bs, and individual retirement accounts. Defined benefit or pension plans do not receive this waiver. There was also an IRS notice that if a participant had already received their RMD in 2020 before the CARES Act came out, they can return that RMD back to the same plan or roll it over into an IRA through the end of August. So a little over a month left for that. The last item, and this is the benefit that the defined benefit or pension plans received, is being able to delay their minimum required contributions to the plan. So it is available for any single employer DB plan that would have otherwise had to pay that MRC in 2020. You may delay that funding until January 1, 2021. But one thing to note is that interest will accrue between the original date that MRC was due and the final payment date, and will be due at that time. So formal plan amendments, they do not, much like the Secure Act, they do not need to be made until the end of 2022, but also much like the Secure Act. If you're making a material modification to your plan, it is imperative that you provide those participants with a notice to let them know of these additional options that are available to them should they qualify. And that is all for all of the fun new legislation affecting our retirement plans.
Awesome. Well, thank you, Callie, for that great presentation.
Thank you all for listening.
Next, we have Henry Talavera from Polsinelli. And I'll let Henry tell you a little bit about himself.
Thank you. Good afternoon. Can you hear me, everybody? Hope you can. I'm Henry Talavera, and I'm a benefits attorney with Polsinelli here in Dallas. And as you can see, you've got the Dallas skyline, Harry Hines Boulevard behind me. Questions that, or the presentation Callie did, if you have any questions on any gray, the difference between third-party administrators and myself is that I deal with a lot of gray, and I go where bad benefit plans go to die and get resuscitated. They're just mostly dead, kind of like in Princess Bride, where they'll come back to life after we address the difficult issues. So anyway, just to let you know, I've got about 30 years of experience as a benefits attorney, and I deal with all things employee benefits and ERISA. And just to give you a little bit of background about me, ERISA, the old joke is ERISA is every ridiculous idea since Adam, because it's just an aggregation of all sorts of laws into the benefit space, and we just call it ERISA. And you know, I love ERISA so much that I wanted to name my daughter, my youngest, Marissa, but my wife wouldn't let me. She said, you have to call her Marissa. And I said, well, that's close enough. And so I've talked to my daughter, who's now an Aggie. Whoop, you know, she's an Aggie. And I said, Marissa, when you have a daughter, you can name her Arissa, so that way I can be the grandfather of Arissa. And she always groans and goes, Dad. But the exciting news is that it doesn't look like I will ever have a granddaughter called Arissa, but I do have an Amelia Marie as a granddaughter, and I spent 3 months, my firm allowed me 3 months sabbatical to the shareholders here. I'm a shareholder, and I got to spend 3 months with her, and it was exciting. And so here's a video of her just on Amelia Marie, and she falls, but there you go. So that's just last week. So I don't get to see her because of coronavirus, but that's it. And so anyway, the way I deal with things and what we're going to talk about today are audits. And you've got, it's kind of like ERISA, things where you think one word is one way and one word is another. You got audits, and you think audits are, you've got an audit of, there are different kinds of audits and there are different kinds of benefit plans. So you've got an accounting audit, and that's one kind of audit. You've got a compliance audit. You've got Department of Labor audits, and you've got IRS audits, and they're all very, very different things. And we've got 60 slides. Unfortunately, we're not going to be able to go through all, well, 59 slides. We're not going to be able to go through all of them, but my contact information is at the back. If you have any specific questions on the slides, feel free to go through. But since we've got, we're a guest here, and since we've got the accountants here, and the accountants do 401k audits, we're going to focus on that. And we'll have, even though you thought you had all of Callie today, we'll have her back as a special guest to answer a few questions, and just sort of the interaction between a 401k audit, retirement plan audit, and the ERISA attorney, and how they interact. These are, you know, who could give you an audit, and these are the things that we kind of work on. You can have the outside auditors, which is Callie and her firm. You could have Health and Human Services, CMS, and that's a HIPAA audit on your, you could have that, and we have attorneys that specialize in that. We've got IRS audits and Department of Labor audits, and we work on those, and in addition to all the difficult questions that we get from a day to day. And so what to expect with Cali, it's a very different kind of audit. It's a, they're just auditing the investments and such to the benefit plans, and they're not necessarily doing a whole lot more. And where we would come into play is in interacting with the auditors if there's anything sensitive to address. The Department of Labor comes in and they'll have civil investigations, and then the IRS has tax issues, and then there's HIPAA compliance issues. So we're going to focus on this, and I'm going to ask Callie a question, but we'll go through the slide. Typically, auditors, and I know when we deal with clients, and they're talking about the CARES Act or whatever, and then we have to give them advice, and they're talking about compliance, or go, well, shouldn't the auditors have caught this on their audit? And I was like, well, no. The auditors, the accountants, do not audit legal compliance in preparation for the 5,500. When they, especially if you're over 100 participants, or even then, what they do is they typically invest the audits. What's typically super important from your end, from the client end, and I'm assuming most of you are clients or represent clients, is that there's a management representation letter, and the auditors rely on that being properly completed. Some clients don't necessarily understand all that's in the letter. I'll give you an example. We have a client on a defined benefit plan, and that's a particular kind of plan. And they had a plant closing, and they didn't know if there was a reportable event to a government agency. Well, the auditors asked that, and the management representation letter kind of addressed generally, were there any notice or reportable event requirements? And it's only when they asked us to help them figure it out, or their actuaries, that they actually got the information that they were wanting. Oh yeah, there was a reportable event. And then we dealt back with the auditors to help them respond. But the auditors, unless it's part of the engagement, don't necessarily ask for that specific kinds of information. And so in the other way we get involved with the auditors, well, let me actually stop there. Callie, do you have any thoughts on what I've raised so far, and on what you audit, and can you give people just a big overview of how and what kind of things that you look at when you're doing an audit?
Yes, of course, Henry, I'd love to. So for our audits, we normally, each plan normally has a third-party plan administrator, and that plan administrator is responsible for making sure that the plan is in compliance. And then the auditors come in and we are testing that compliance. So what we do during our audit, the majority of our audits, we do about 70 employee benefit plan audits each year. The majority of those are limited scope audits where the third-party administrator, the custodian of the assets, is certifying that the assets are complete and accurate. But we also take a sample of testing contributions to the plan, testing distributions and loans, as well as testing participant data and their accounts to make sure that those employee deferrals are being calculated correctly, that the match is calculated correctly, that they're being remitted to the plan on time. And generally that compliance has been made with the plan being the fiduciary for their employees' funds. Any issues that may arise, if it can't be something that's resolved through the audit or through the plan sponsor and their third-party administrator, that's when we'd come to someone like Henry and suggest, recommend that legal involvement is obtained in order to bring the plan back in compliance.
Okay, thank you, Callie. That's exactly right. And what we deal with, so Callie will address, and the audit will address specific issues unless you raise it with the auditors. And if you're unsure, it's very important that you do so, or you ask your attorney or your consultant, whoever it is, to make sure that you've addressed everything that you need to do. Sometimes we get involved in audit, and they call it legal compliance audit. And the big difference between us and CPAs is, or a difference actually, is privilege. So if you have an issue, like for example, you've got where you haven't, the Cali does the test, and it looks like there's bonuses you sort of deferred at and you didn't, and your plan is gray. We're always very good in helping come up with the best arguments possible that there's gray. And if there is an issue, then we can help the client correct any kinds of issues. Now, the difference between us and Cali, if you tell us and you go, Henry, you know, we like you, this is great that you say this needs to do that, but you know, go pound sand and we're not going to do anything, then what we would say is, okay, that's fine. And, you know, you don't have to do anything we say. You know, it's kind of like your kids. Sometimes you tell them and they want to, you know, they just have a mind of their own, and that's fine. And clients don't have to listen to us. Callie, on the other hand, it's a little bit different in that she can't complete her audit with something that's outstanding, that's unresolved. And so typically how we would handle it is, if there's an issue that Callie finds in her audit, and then you come to us and we say, okay, this is how you fix it, or Callie says, okay, this is how you fix it, then we would provide a what do you call it, a caveat in the management representation letter that says, okay, there's this issue, but we're going to fix it. And that typically will satisfy Callie and her team on a go-forward basis. And so Callie talked about, you know, sort of what auditors do in the legal compliance. And there's a fine line between what Callie will audit and what we'll audit, or what we'll talk about. And you know, attorneys deal in the land of the gray a lot of the times. And the number one issue is dealing with the timing of employee contributions. And it's how we typically would be involved in an audit. Actually, one of the more fun ones we got to be involved with was someone who embezzled money from the 401k plan. Well, actually, not from the 401k plan, that's easy, from the employer. And the employer wanted to not pay this individual their 401k plan. And so we got involved in the middle of that. And it's not a great idea not to pay someone embezzles, but there are things that you can do and that we could help you with. And in that situation, it actually ended up to be a happy day for the client. But those are issues that the auditor will just say, whoa, you know, we don't want to get involved in the middle of not paying someone their 401k plan, because the Department of Labor has very strict rules on when folks are allowed their 401k. But there are some exceptions, or even some other issues that you or actions that you can take to address. But those are the kind of thorny issues that you can deal with. The other one is the timing of employee contributions, and that's probably the number one issue. So if you're late, and the way it works is contributions, so these are 401k employee monies, are due to the plan when the assets can be reasonably segregated from the employer's general assets. You know, what is that? I don't even know what that means. But the Department of Labor has come up with a specific guidance there, and in interpreting in the rule, which is they have to be segregated when the earliest time is that those contributions could be paid. So the Department of Labor's view, and it's not the law, it's the Department of Labor's view, is that if you have ever contributed those monies, let's say 7 business days, and that's what you typically contribute the money. If you ever go after 7 days, so let's say it's 8 days because you had someone who was sick or there was change in personnel, that would, if you miss it by 1 day, you've engaged in a prohibited transaction. You've got to check the box and on your 5500, and you've got to probably submit a penalty to the IRS unless you go through some hoops, and we discuss it later on to get an exemption there. Well, you go, hold it, it's only 8 days and it should have been 7 days. How is that a problem? Well, the auditors are a lot of times, and you know, I'm talking about the Cali here, are sometimes restricted by what the Department of Labor would have as a strict view and what they've been told by the Department of Labor. Lawyers can kind of wiggle room around that and say, okay, if we had someone that that was absent and there are good reasons, we could probably come up with a good reason that 8 days is not a prohibited transaction, so you can check the no box. And there wasn't a prohibited transaction, and Callie would ask for our legal opinion. And there's not really a legal opinion, but it's more of advice, and that they put that in their files and their work papers, and that would be that. And that's one that we typically work back and forth with Callie's team. One of the things that limits Callie's team is that the Department of Labor does a random audit of the accountants' work papers that they use. And so unless they have legal guidance, even though the Department of View is not the law, without legal reasoning, the accountants are sometimes constrained. Some aren't. Some are a little bit more flexible, or will bend the rules a little bit more. Not Callie, of course, but they would rely on the opinion of legal counsel. And so that's sort of an example. So if you ever run into a gray issue, that's where it's really important to visit with an attorney to be able to get the guidance that you need. Callie, do you have any thoughts on anything I said? You don't have to comment, but is there anything that you want to add to or subtract from what I said?
Of course, I do agree with you that the timely remittance of employee contributions, it is extremely important in a 401k plan to make sure that once you have run your payroll and you withheld employee deferrals from their paychecks, you essentially have your employees' funds in your employer's bank account. So the part about reasonably segregated from the employer's general assets is how quick can you get your employees' money out of your bank account and get it into their 401k plan account so it can start earning money. And that's essentially what the DOL is trying to get at here, is the sooner you can get their employee deferrals remitted to the TPA, posted to their plan account, they can start earning that investment income. And that's what's so important here, and why when participant contributions are delinquent, that is the penalty, is that the employer is having to make up for lost earnings, or the earnings that the employee lost by their money not being in the plan sooner. So I think that's why it's such a focus of the DOL, and something that they've been focused on even more in recent years, is to make sure that the employers, the plan sponsor, are handling those funds adequately.
Yeah, thanks, Callie. Yeah, and it's interesting because, just to cut to the chase on this issue, is if the Department of Labor, and we've been subject to these audits tons and tons of times, if the Department of Labor's position depends, of course, on the dollars involved, but let's say you have our example, they should have been contributed 7 days and you contributed it 1 day late. The Department of Labor is very aggressive. And the issue is, I could fight about it, but when you look at the actual penalties and the interest, we're talking pennies on. And so most of the time, even on a 2 or 3 days late, it's usually not enough money to fight the Department of Labor, or even challenge it. You just take your lumps. You go, okay, we'll go ahead and pay it the seven days. And the reason why there's not more litigation on this, if you went and looked at the case law, there's hardly any, is that the dollars aren't typically a lot, but no one wants to say, because we were late, we've engaged in a prohibited transaction. It just sounds awful. So anyway, but it's not a huge issue, but it's still one that's very important, and illustrates how the legal and the accounting overlap. So let's say you get a request from the Department of Labor, IRS, and that's an audit too. And you can have it on different kinds of plans. We've done welfare plans, and welfare plans, it's funny, we had a client one time said, I don't believe in welfare. But no, these aren't that kind of welfare. These are like medical, disability, life insurance. Those kinds of plans get audited by the Department of Labor, in addition to your 401k plans, your retirement plans, the defined benefit plans. Sometimes executive compensation plans can get audited. So anyway, you can get, all those have been audited, and we've helped our clients deal with those sorts of issues. Typically you get these really threatening letters, and it looks like a subpoena from the Department of Labor. Sometimes it can be more informal. The one thing that's super important, when you get a letter from the Department of Labor or IRS, please don't ignore the letter. That's probably the worst thing you can do. One of the worst, and the second worst thing you can do, I think, is not have counsel help you, or at least some consultant, somebody who knows what they're doing, because now you can have various people. Callie could represent you before the IRS Department of Labor. It's a little bit more expansive, but you need someone to help you deal with the Department of Labor, because if you respond, actually, we've got an audit right now where somebody didn't use us and they responded, and now the audit's going on 5 years because they responded in a way that triggered the Department of Labor to ask more questions. And so now, I think the client's done nothing wrong, but anything, you've seen the TV shows, anything you say can and will be used against you. That's how it works with the Department of Labor. Actually, there's a case going on where an Indian tribe went to ask to the Department of Labor on some matter, and now they're in court because the Department of Labor didn't like the question. And so it's super important when you get one of these. They can come in the form of a subpoena. You can get a letter from from the IRS. One thing to always do, if you can, is have someone knowledgeable to interview when you set up to talk with the Department of Labor. So anyway, it's important, and you can get extensions. I'll say this on the timing. Typically, the IRS, the Department of Labor are super nice. If you say, I need a little bit more time, they're super, flexible, especially if you have counsel. They don't have to come out on site, even though they like to do that. Sometimes they come to counsel's office. So there's lots of things that you can do if that timing gets accelerated. If you don't get an extensions, then what you will know from that Department of Labor IRS agent is that there's something very, very serious at issue. And one of the most important things we try to do as counsel is try to slow the timing down so that things can be reasonable and you can negotiate. Because once you get close to litigation, it gets very expensive, of course, and it gets so much more confrontational. And one of the things you don't want to do is be confrontational with the Department of Labor or IRS if you can help it. So in similar to Callie, so that's why when you look at audit, the IRS is looking at the tax returns, which is the 5,500. So when there is an IRS audit, what they are doing is looking at the return that Callie and her team are preparing. And they'll go through, and especially on the 401k side, and then they'll do, instead of what Callie did, which was a sample, which is why it's always good. You can't always rely on what Callie does. And so it's very important to understand where Callie and her team ends and where your responsibilities start. Because when you have an IRS agent, they'll get a sample, but they'll get a much more full sample, and they'll come out and just make sure, not just that a sample, but that all contributions are timely, that all of the matches up, that everything has all the deferrals, or the elective deferrals are proper. And actually, one of the most important things that you can do, and that Callie and her team would not hardly ever deal with, and that's probably the number one thing to look at, are your plan documents. The IRS, because of cutbacks, several years ago stopped giving IRS determination letters on plans. So now you get something called an opinion letter. And what that does is the IRS will say, well, do you have a current opinion letter on your plan? And it's something that, and Kelly talked about it, your third-party administrator, record keeper will give you. But that doesn't end the story there. The IRS will ask for documents 9 out of 10 times back at least 2 cycles, they call it. So roughly back to 2010, 2009 or so. So here we're in 2020. And actually, they might ask for documents back to 2001, 2002. That's just 2 cycles. And that's been our experience as of late. I haven't had any audits in the last 6 months. Maybe they've stopped that. But as part of the audit, if you don't have your documents back in a good order back to 2001 or 2, the IRS could fine you and disqualify your plan. So it's very important. And actually, how it comes up more than anything is if you ever are going to sell your company, there's actually kind of an audit as part of selling or buying a company. You would look at the plan documents, and one of the things that you have is a representation that says all of the documents or everything has been timely adopted and amended. And more times than I can count on, there are fixes that are required as part of a due diligence and an audit as part of a deal. And so it's if you haven't looked at your documents, it's very important, because that's not something that's ever part of an audit. And it's something that, especially if you're going to sell your company, or if you're just looking at plan compliance, it's important to know. And I'll tell you how we typically file something called a voluntary compliance program application. And how this will come up is someone will have a question on, like we had a question, should partners be, and what compensation should you use for partners in a partnership participating in a 401k plan? And it turns out that partners were excluded in this one plan document. Well, you go, well, how long has this happened? And then that's when you start looking at past documents. So now we're going to look at, so that's the IRS. The Department of Labor focuses on a almost completely different area. They look at eligibility. So to Callie's point, there's a new law that says you've got to have part-timers. Well, it's going to be important to figure out how you get your part-timers in, and now is the time to look at it for next year, because the Department of Labor will focus on, have you included the right people in your plan the way you're supposed to? We talked about the contribution and the timing. Now that contribution timing issue doesn't apply to match or anything like that. It's only the employee deferrals, but the Department of Labor actually looks at that issue more than the IRS. Other things that are really important that are outside of the scope of most any audit is there's an audit of your investment processes. And so there's fiduciary fees and stuff, and we've been involved on clients being sued and defending clients on the investments and the fees. And so the Department of Labor will look for that, and they'll look for something called a 408B2 review. And that's in reviewing all of the investments that periodically should happen, and to make sure that your investments are prudent. Even though you have something called ERISA 404C that transfers some of the liability to participants, that doesn't always occur. And so, and that the required notices, and then the Department of Labor doesn't care about back documents. They only care about your current documents in place. And again, your annual reports those are very, very important annual reports that the 5500s. I'll tell you where it gets dicey on reporting is what's a plan. And you would think, oh, a plan is a plan. But sometimes I'll give you an example. You have something called a RAP plan. I'm sure you've heard of that. It's not required, but what it allows your medical and your dental and your vision all get to be filed under a single 5500. Well, sometimes your RAP doesn't include your flexible spending accounts or something, and then the Department of Labor says, well, where's the audit on this plan? And that's where we can come in. So, and then if you've got, anybody heard of an ESOP, an employee stock ownership plan, you can have stock issues. But those are specific issues that, that actually in this economy, if you've got any stock in your company plan, then you need to look at that carefully. And then, so one of the questions that we typically get, okay, we have a Department of Labor audit, IRS audit. How does the timing look like? We've had IRS Department of Labor audits that can last, and even in difficult situations, that can last months. But we've got a Department of Labor audit that's been going since 2015. So they can last years. And how do you get from several months to several years? The issue is that it's really important to be cooperative with the Department of Labor. And it's really important, again, with counsel, with key advice, because sometimes you're cooperative, but you're cooperative in a way that makes the Department of Labor find more problems. So there's a fine line between cooperation and then once you find a problem, being able to fix the problem quickly. Because one of the challenges that we've had is that we have a client that has been audited by the Department of Labor, and right before COVID hit, the Department of Labor got mad because things weren't going as progressively as the Department of Labor, or progressing as the Department of Labor wanted. And in the middle of coronavirus, we had to really ratchet things up, and the Department of Labor just didn't care. And part of that is it's really critical to when there is an issue, to fix it as soon as possible. Sometimes it's like in that case, it's just not possible. And the Department of Labor, back when I was in the federal government, we used to call them, they were in their ivory tower, and they don't quite understand that the real world things take a lot longer to happen. But it is what it is. And so what happens is when at the end, from an IRS standpoint, you'll get a closing letter saying all is well. And from the Department of Labor, you'll get a letter that's 30 pages long that says all the horrible things that you've done. But because you fixed it, we're not taking any more action. One of the most important things actually in dealing with the IRS or the Department of Labor is to resolve everything without a settlement. And that involves fixing things without actually signing on the dotted line. If you're signing on the dotted line, that's typically not a great response. One of the things that's really important as you're going through the audit situation, and what's an audit, is to self-audit. It's really important before you get to Callie, before you get to me, if you can, is to make sure you've got a complete set of documents. Review, make sure that somebody, you get these documents and you assume someone else, and the record keeper's not responsible. I bet you if you look at the contract, it'll say they're only responsible for a small set of things. And it's to review everything and make sure you understand it. One of the worst things that you can do if you get audited is the Department of Labor says, well, have you ever looked at your documents? Have you ever read them? And we've fortunately not had that, because we say, hey, before the Department of Labor, IRS comes, make sure you read your documents. It is that one of the worst things you can possibly do, and it's been done because what's happened is the client has responded, and once you say you've not read anything, then the Department of Labor, IRS, will ratchet things up, because it's like the canary in the coal mine. It dies. It's an indication that there's lots of problems, and it's easy pickings. And so these are things that are really, really important for you to review as you go through everything. And I think with that, I'm going to pretty much wind it up. If I do want to let you know, I was with my grandbaby Amelia for 3 months I was saying. And one thing that I always did with her is I sang Somewhere Over the Rainbow, and she liked it. I'm going to end with that, but change the words up just a little bit for the audit, and just to give you a taste of what Amelia experienced. And there's my contact. Here we go. Let's see if it would work. I'm talking, so I'm a little bit hoarse, but we'll give it a go. Somewhere over the rainbow, audits go. There's the DOL that I heard of, Consina lullaby. So you have to avoid the Department of Labor. So thank you.
Thank you,
all.
Henry.
Thank you.
We appreciate you joining us. As this situation is constantly evolving, please make sure to follow our events page for more information. The link is in the description below, along with other important links, including our social media platforms. If you want to see more of the Lane Gorman Trubit Summer Survival Webinar Series, subscribe below and hit the bell icon for notifications. Thank you.